Over the past 1.5 to 2 years, global central banks hiked policy rates aggressively by more than 500 bps each at the Federal Reserve Bank and at the Bank of England, by more than 400 bps at the ECB and at the Reserve Bank of Australia, just to name a few. Looking ahead, we expect most major central banks to embark on an easing cycle, albeit with different timelines, which will be a function of macroeconomic development, in particular inflation. There has been progress in bringing down inflation in major economies. Further disinflation hinges on continued stability in energy prices and on easing in services inflation. In particular, the Fed watched inflation in core services excluding housing. Assuming disinflation continues, we expect US Treasury yields to go further lower over the course of 2024. At the front end, market pricing around 150 bps of Fed rate cuts in 2024. And we also see at least 100 bps of cuts. Although market is already pricing in aggressive rate cuts, as time goes by, these rate cuts, which are currently priced, will be increasingly factored into the valuation of short-end bonds. This is to say, even with the same rate cut expectations, short-end yields are likely to fall over time as these rate cuts become nearer. At the longer end, we like to break yields down into two components, break-even and real yield. Break-even represents inflation expectations. A US break-even rate at 2 to 2.2% shall be seen as desirable from a policy perspective, as this is consistent with the Fed's 2% inflation target. As for real yield, the 10-year US real yield has dropped from 2.5% to around 1.7% as we had expected. But we see some room for further downside to real yield as the US economy is expected to slow. However, complicating longer end yields and hence the curve is the term premium. Term premium reflects uncertainty on the interest rates outlook and other factors such as US fiscal position which affect bond supply. The risk is the term premium can go up. Overall, we expect US Treasury yields to go down over the course of 2024, but long-end yields may not go down as much as front-end yields do. The curve has potential to steepen. We see potential for the 2-year Treasury yield to fall to the 3.4–3.5% area by the end of 2024, and the 2-stance part of the curve to turn positive sometime in the middle or the second half of 2024. Apart from policy rate cycle, let's not forget that there is quantitative tightening, QT. The Fed, BOE, and ECB have been carrying out QT to various extent. QT can still continue even when central banks start to cut interest rates, as central banks see QT as happening in the background or as a separate decision from policy rates. We believe the liquidity situation is an important factor to consider as to whether QT can continue. In the US, with the liquidity parked at the Fed's reverse repos and some buffer in bank reserves, QT may be able to continue for most of 2024. At the ECB, they have just decided to add to QT through one of their two portfolios. The BOE has also planned for another 12 months of QT, which ends in September 2024. QT may reduce the downside to yields and rates in general. The monetary policy pivot may have a different or just the opposite meaning for the Bank of Japan. The BOJ has maintained its ultra-loose monetary policy when most major central banks were hiking interest rates. The BOJ did tweak its YCC, yield curve control, but has maintained a negative interest rate policy. We expect the BOJ to exit its negative interest rate policy sometime in the first half of 2024, sooner rather than later. The risk, however, is that the BOJ might have missed the best time to normalize monetary policy. To sum up, 2024 is likely to be a year of the great monetary policy pivot. We expect interest rates and bond yields to trend lower in general, and yield curves to steepen as a normalization process. The risk to our bull steepening view is inflation staying elevated and central banks turning out to be more hawkish than expected.